I come from a space and very, very blessed and fortunate. In my first full year in real estate, I paid more money in taxes than I'd ever made in my life in a year's time. Welcome back to another episode of All or Nothing in Real Estate. I'm your host, Matt Smith, the founder of All or Nothing in Real Estate. This podcast is a movement to give back to this amazing industry that has given so much to me and my family. Guys, today we have a very, very special episode. One of my good friends, a elite business operator, and honestly, just out of the kindness of his heart, he called me one day about some tax strategy things. And an hour later, my jaw was on the floor and I was blown away. And so I want to bring, as always, to our audience stuff that is relevant and proven and things that are needed in the marketplace. And so without further ado, I have the one and the only Michael Perna. Welcome to the show.
Hey man, thanks for having me. I really appreciate it, and I'm honored to be a guest on the show. It's a podcast that I watch myself, and I gain a lot of value from. So thank you for doing this. Really,
Awesome,
seriously.
man. Well, I appreciate that. That means a lot coming from you because it's mutual. I learn a lot from you guys and love that we collaborate and are like-minded. And for those of you, those that don't know, give us a little bit of background about yourself, your
Sure.
team, your expertise.
For sure. So I've been in the real estate business for 23 years. I'll be 24 years in February. I have a team of about what do we have? 78 agents as of yesterday. We'll do about 1,000 transactions, about 250 million in real estate.
Let's go.
Let's go, bro. Let's go. In addition to that, myself and two partners own a title company. We do about 450 units a month through that mortgage company. And then I'm hooked up with insurance as well. I don't own that company, but I've got a JV with it.
Nice, nice.
Yeah,
So,
trying to get a
guys,
little
I
bit, a
think I
little bit
think
of
you
every
will.
piece. Yeah.
Yeah, I think you will realize that this is a very, very, very high level business operator in the trenches. And so I just want to encourage you to, if you're driving, maybe pull over and don't do the re-listen to this later, but you need a pen and paper for this one. There's going to be some rider
Definitely.
downers. There's going to be some things that you can implement because what we're going to focus on is something that real estate agents sometimes, myself included, forget that we have in this industry, and we have to pay these crazy things called taxes. And coming from my personal experience, most of the listeners will know, but I come from a space and very, very blessed and fortunate. In my first full year in real estate, I paid more money in taxes than I'd ever made in my life in a year's time. Right. Like, so
Yeah.
that transition for me was like a holy smokes moment. And if I would have known these strategies, these tactics, these things that Michael Perna will break down for us today, I would have been able to keep more of that money for myself through strategy, 100% legally, right? Like I want to be clear,
Yep.
I'm not a CPA. I don't think he's a
I'm
CPA.
not a CPA as
So
well.
this
No.
is not legal advice. This is strictly our opinions. However, it comes from an operator doing it at a very, very high level. And before I cut him loose, I want you guys to realize, and I want you to have this mindset before I cut him loose and sharing these things. Sometimes it's not how much money you make. It's more important how much you keep. And he's going to give you tactics and strategies to keep more of your hard-earned money in your pocket.
And that's exactly right. And that's exactly right. I mean, and at the end of the day, there are three fundamental ways we can increase our income. We can, I mean, and that's outside of like, let's say being a basketball player and I'm 5'10", so that's not going to happen. Or inventing something and I'm not that bright, so that's not going to happen either. So I can either work harder, and there's only a finite amount of work harder there is in the world.
Yep.
I can invest in something that will give me returns like real estate, which I do, or I can decrease my tax burden. And when I say decrease my tax burden, I mean decrease it, in my case, by $130,000 a year. That's the tax strategy that we're going to be working on. And I don't want somebody to shut off the podcast thinking, okay, this is way too much for me, because anybody at any level can employ many of these tax strategies to reduce your burden, even as much as 10,000 or 15,000. And I know that sometimes when we get into real estate, we think about these numbers and they're so big, but think about it, guys, like how much of an impact can just $10,000 have for your family today? And
Yes.
then next year, and then the next year, and then the next year. And 10 years down the road, you've increased your net worth by $100,000 by just employing a few basic tax strategies. And I'm going to run through them, basically going from easy button to more advanced.
Yeah,
Okay.
let's start with like somebody that's like taxes. What in the world is that?
Hmm.
Right?
Hmm.
Like I
Yeah.
would love your opinion on because I mean I coach some of my agents, right? They're new to the 1099 game, they're new to
Yep.
all of
Yep.
that. And so let's start and honestly there's agents that have been in it 20 years that probably don't understand this. So let's unpack what does it mean to be self-employed in this industry and what should they
Yeah.
do to be prepared?
No, and great place to start. Animal, vegetable, or mineral. At one point in time, we were all in that W-2 category. Not all of us, but many of us were in the W-2 category where our partnership with the government, they decided that as a partner to us, they're going to be kind enough to take their portion of the money before we get ours. 1099 is the opposite. The government says, hey, we're going to give you all of the money, hoping that you at least reinvest some of it into something that will produce more jobs, more business, more sales, keep the economy going. But then at the end of the year, whatever portion you don't, then we want that portion of the money. We want our taxes on that portion of the money. So let's say that's just as a basic. Let's say we make $100,000 in real estate. We spend $30,000 on marketing, pay Google pay per click, right? Okay, great. Our taxable income is not actually 100,000, it's now 70,
Yep.
right? So now we're taxed on the 70 versus the 100. The 30 that we spent to generate business, we're not taxed on because what happens is we go and sell a house and then that person goes and has to buy a hot water tank to replace their hot water tank. They're now employing a plumber, they're now employing people in a factory building a hot water tank, so on and so forth. The definition of a good economy is actually not how many dollars are in it, it's how fast the dollars move in a circle. So the
Mm.
government's very interested in keeping those dollars moving in a circle, and most tax strategies are based around that. Most of the tax code is based around that. So when I got into real estate,
I
I
want to stop really
yeah,
quickly. You just taught me something again.
yeah,
That I mean, I understand economy at a pretty deep level, but like that just opens up a whole new way of thinking for me. And now that, dude, thank you for that because now the tax code that is so confusing and overwhelming
mhm,
is simplified for me. Like
yeah,
that's why these rules are put in place. That's why these exceptions or whatever they're called in tax language, that's why some of these exist is because the government wants the money to keep moving and
as
keep
fast as
flowing.
possible.
Yeah,
In
really
fact,
good.
yeah, and I mean, the government can literally print more money and add it to the economy, and all that ends up happening is inflation. And
Yep.
we've seen that. We've seen that through the COVID years,
That just
right?
makes the dollar worth less, right?
That's it. That's all that happens. But the faster I pass along that dollar and the next guy passes along a dollar, I buy a car so that factory worker can go buy a refrigerator, and then that guy can go buy a washer and dryer, and then that guy can go out and eat at a restaurant, and then that guy can. That's how we get into a healthy economy.
Yes, I love it. I love it. I want to, for simplification, I want to start here, and I think
Mhm.
we're on a similar page, but I'm just curious. Some, I believe, and I coach and train my agents. One of the first things that they do once they graduate boot camp, we go into what's called onboarding, and part of our
Mhm.
onboarding stuff is literally it's just a tax 101, right? It means like you're now self-employed. If you what how much money do you plan on making? That means it puts you in this tax bracket. And in our team, you don't have much expenses, so I can have a pretty good
Mhm.
idea
Mhm.
of what that looks like. And whatever that percentage is, call it 20, 25, 35, whatever that tax bracket is as a percentage, I recommend they open up a bank account and every commission check that they receive, they put that portion into that bank account so that at the end of the year when they get this tax bill, it's not like, "Uh-oh, what do I do now?"
Yep. And I wholeheartedly agree with you, Matt, on that. And I would even take it to even a further level for some of the people that are very new at this.
Okay?
Um, so with taxes, we've got to pay them on a quarterly basis to avoid fines and fees and all of those things, as long as we're paying more than $10,000 per year in income tax. Anything less than 10,000, we're allowed to do it once a year. But then here's the problem. Let's say that we make $100,000 just net revenue, and then let's say we owe the government 22,000, and then that breaks down to 5,500 per quarter. That's a lot of money to come up with in one check,
Yes.
right? And that's where I agree with you on opening a separate account. I would actually open it at a separate bank where I don't even have the app on my phone. Like
Yes.
I
You forget
cannot
it
access
exists
it. I
until you
can't
need it.
touch it. Yep.
Yep.
And then I would go with something like maybe an Ally Bank, partially because they have some of the best interest rates out there. So at least you're earning 4.5 to 5.5% on your money. It's just not just sitting there doing nothing. You're at least getting something instead of
Yeah.
the 0.25% interest that a normal checking or savings account is giving right now. At least you're getting a little bit of something, right?
Sure.
All my reserve accounts that are cash are at those style banks where I'm actually at least earning something on the couple 100,000 I keep in reserve, right? If you're worried about it, and I did this myself because frankly, no one taught me how to tax plan when I got into real estate. My broker did not have that conversation with me like you do, which is fantastic that you do, by the way. Nobody else does this. Nobody. I got myself into tax hot water. And I had learned through one tax professional, hey man, why don't you break it down even smaller? Because trying to write a check for 5,500 a quarter is big. That was actually
Yeah.
my number. Why don't you break it down to a monthly basis or even a weekly number? And so what
Mhm.
I did for a couple of years, just to stay on the straight and narrow and keep myself out of tax trouble, and tax trouble is nothing to be ashamed of, my friends. I mean, you would be amazed how many people have owed the IRS money that they just will not talk about because it's
Yeah.
hard to talk about. It's very personal and it feels like a failure, but it's a lot more
Mhm.
than you think. So if you're listening and you're like, shit, I owe, 25 grand to the IRS and I don't know what to do. Hey man, there's help out there for you.
Yep.
Really. It's much more common than you think. So I broke mine all the way down at one point to a monthly level where every month I would write a check to the IRS directly. I wouldn't even keep the money in my account. It wasn't even owed yet, but I would just want to get rid of it so I didn't have to think about it or even worry about it. So I kind of almost put myself back into a W-2 position when I was a
Yeah.
young, reckless youth of a guy just trying to make it on the mean streets of Novi, Michigan, just for a couple of years until I kind of got my financial footing back. And then I backed it off, then back to the quarterlies.
I love it. And it goes back to it goes back to a principle I learned really, really young. I had my first job when I was 12 years old. I worked at a sawmill getting paid $20 a day to stack slabs. And I
Mhm.
remember just the way I grew up, my mom worked three jobs, worked her tail off, and we just didn't we weren't poor, but we didn't have as much money as she wanted us to think we had. Right? Like
Yeah.
she worked
Yep.
three jobs so that I could have a new pair of shoes for school, right?
Yep.
And anyway, long story short, there is I remember taking that $20 a day and I never spent a penny of it for 2 years. And I had one of the big box TVs before we had flat screens, and that was my bank. That's where I kept my money, right? And I just
In the TV.
remember
Yeah.
once I transferred that to a bank, I started saying when I started getting real jobs and real income, I paid myself half of the money that I made to save because I was afraid I never wanted to be broke, or I always wanted to be able to be an insurance policy for my mom who worked so hard in case we needed something. Right. And so, like, I
100%.
think that
Yeah.
same philosophy would serve people well listening here is that just it's not your money just because you get 100% of it.
Yep.
Right. Just
It is
realize
not.
that we have a responsibility as Americans in this great country that there is tax liability that we have to pay. And so if you just treat it as if you were W-2, because you may not, and a lot of people maybe don't understand this, your previous W-2 job, all that stuff was done prior to you receiving your money. The
Yep.
difference is now if you're an agent, you are a 1099, which means that you get 100%, and now you are responsible for paying the government whatever that isn't taken out of the amount of money that you owe them.
Exactly. And you really, really nailed it. And
Yeah.
I think people underestimate that. And if you are in some sort of a tax trouble position, call the IRS. They are not the big bad scary monster that people think that they are. They will be willing to work with you. They will put you on payment plans that will span 2 years, 5 years, 10 years, whatever it takes, right? These guys are not looking to incarcerate anybody. That's not what they want. They want the tax money and they realize that sometimes people get in the hot water.
Yeah.
When I got in the hot water, I was very thankful. I had a financial person in my life that said, just pick up the phone and call them, see what happens. 45 minutes later, I had a tax plan worked out. And over the course of the next 3 years, I caught everything up.
Really good.
Easy. It was actually a lot easier than I thought it would be. And it was also easier because I was being proactive instead of reactive.
Yeah.
They're willing to work with me a
They're
lot
more
more.
likely to work with you if you're showing that you want to work with them.
Absolutely. Absolutely.
Awesome, man.
Yeah.
I don't want to spend a lot of time on this, and I don't know.
Mhm.
I think this is state by state, but
Mhm.
another thing as far as like setting up that it depends on your income. And again, I'm not a
Yeah.
CPA, and it depends on your state laws, all of that. But I found a way. I don't know the number. I think it's 14%, 14 or 18%, something self-employment tax
Yep.
that I save by I'm with EXP as my broker. I think you are as well. And they
Yep.
allow for me to have, and then my state, my LLC, my company has a real estate license, and my company receives the commission. And then I pay myself a salary from that company that is reasonable wages, right?
Yep.
And then what that does is the difference in the two, say $100,000 is what the company makes. Well, now I save this isn't the actual, right? There's other things here, but just for argument's sake, now I save 18% or whatever that number is on that $100,000 just by the way I set it up. And so there's a
Yeah.
certain threshold of income where that makes sense or it doesn't. And so I think that that's something that a lot of people don't understand they have the opportunity to do to reduce their liability.
Well, and let's talk about that a little bit because I literally just had that conversation on a coaching call this morning with one of my guys. And I will say this podcast is at a very opportune time with the election behind us and what's going to probably be coming down the pipe for taxes as well, which is what we're talking about. So, like in Michigan, you have to be a real estate agent for 3 years, active real estate license. Then you can go get your broker's license, and then now you're considered dual license. You have an agent and a broker license, and now you can open up an LLC, an S corp, a C corp, sole proprietorship, partnership, whatever entity that
Yep.
you can feed those commissions into. And then, as you said, take a salary on a portion and then take the rest as owner's profit. Owner's profit is taxed at a much reduced rate over a wage, right?
Yep.
But to do this, right, you've got to open up that company. This is where I highly advise talking to a tax professional because when I did it back in 2008, it looks different than it does today. So when I did it, I opened up an S corp. But at that time, LLCs could only be taxed as either a sole proprietorship or a partnership, which was a higher tax bracket, higher tax rates than S corps or C corps. So I had to open up an S corp. I didn't have a choice. Today, LLCs, you can choose the tax status on a yearly basis. It's
Mm.
much less on filing fees, much less on what you have to file every year, much easier to do. You can go right on your state website and file an LLC today. It's cheap. But if I were going to do it over again, I would choose an LLC and then choose your filing status as to what is most advantageous. For me, that's S corp.
Gotcha. Really good advice. And I
Yep.
think too, he speaks like a tax professional, but again, I just want to protect him in this podcast.
Thank you.
Neither one of
Thank
us
you.
are
I
tax
am not.
professionals.
I am not a tax professional at all.
We have done this in the trenches, right? And
Yes. Yes.
this stuff is what we personally do and teach other people to do. But we also, like he said, have the advice of an actual professional too that we recommend you reach
Always.
out to.
Always,
Yep.
always. All my harebrained crazy ideas, I bounce off of three accountants because I
Yeah,
just want to be sure that this can be done.
I love it.
And the reason three is because some of them don't even know about this stuff, which is an issue with
Ooh,
tax
don't
professionals.
even get me down that road.
Dude, a lot of them just haven't kept up because they don't have the same. The continuing education system for tax professionals is just it's non-existent, for lack of a better.
Sure.
New tax codes come out, new statutes come out, and there's no real requirement for them to learn them. And so most don't. But then again, 95 or 93% of Americans are not business owners. Only 7% are. And we should be
Yeah,
considering ourselves business owners. So 93% of the returns they're doing are your standard W-2. Hey, how many kids do you have? One, two, or three? Because you get different deductions for each one. You filing joint or married or single or married. Like it's all check boxes for the most part. That's why H&R Block is so successful, being they can
sure.
process so many tax returns at such a low rate. That's why TurboTax is so successful because they're all really just the same. It's just a different company name that the wages are coming from for each individual.
Makes total
Other than
sense.
that, it's the same. But for us,
I want to throw this out there for those that may like. Here is my personal experience. Is that I feel like CPAs that I've worked with in the past, I feel like they work for the IRS and not for me.
agreed.
And
They're
so,
very much afraid of the IRS
yes,
because when they're submitting the return, they're attesting to that return, which means that they're taking on that liability, right?
yep,
And so they want to take over as little liability as possible, which I appreciate and I respect that. I would want that
sure,
as well,
absolutely.
right? So now you got to look for a tax professional that's willing to push, not push the edge, but go towards the edge, go
Well, and
towards
I
the fringe parts of the tax code that nobody
sure.
reads.
And I live my life in the gray area, right? So do you, I'm
Yep.
sure, right? And
Yep.
so like we're always pushing boundaries, but for someone that's even maybe more conservative, I want you to not tune out and I want you to listen to this. And I think there's a difference in someone who files taxes and someone who helps you build a tax strategy.
Correct.
And
And
you
the
want a
tax strategy
strategist.
should, yeah, the tax strategy session with your accountants, you got a good accountant when they contact you in September and say, hey, look, we need to have a tax strategy session sometime in the next 30 days for the next year. They're
Yep.
not doing it in that year for the previous year. They're not coming to you and saying, all right, man, it's March. Let's look at your 2023 numbers. They should be saying, hey, it's September. Let's project out your 2025 earnings and what tax strategies you're going to utilize to defray the IRS cost.
Yep.
That's what they
100%.
should be doing. That's how you know the difference between a true practitioner and just a general practitioner.
And I want to give some people advice, and I'm not gonna name drop them here, but I was very, very fortunate at an event that I was at. I was in Cabo where I spoke last year, and I met an individual that owns a company that specializes in a few things for entrepreneurs. Really genuine, down to earth guy. Perna, maybe I can connect you with him too if
Yeah,
it would be of benefit.
I'd
But
love
like
it.
really, really genuine guy. Like it just he was some of our people, right? And had lunch with him and really got to know him. Come to find out, he had helped me create some of my LLCs and some of my entities and different things through his online platform,
Oh,
right?
that's
And I got to actually know the owner and we were talking, we were having conversations, and I said, "Man, thankfully, I found your stuff because it helped me set up a lot of these things that my local people weren't understanding." Right.
mm-hmm.
And he's like, "Well, that's what
Yeah.
we exist for. We solve a problem." I realized as an entrepreneur myself, these are things that are they're uncommon. And so the common person doesn't understand at the level that we need them to. And so I just started specializing in it. And he said it just exploded. Right. And so he has an arm of that is tax strategy, that he has a third party company that I think he just purchased so that he could have more control over to help people through this. And so if any of you listening would like an intro to them, reach out to me. I have no affiliation other than I'm transferring to them, and they have been phenomenal. And they understand this, and they want to talk through on how can we reduce tax liability, not just hey, file your paperwork.
Yep.
And so if you want a
That's
referral
fantastic.
to that, if you want, just reach out to me, and I'm happy to connect you. I
Yeah,
don't know
I
if
will
they'll be
be.
great for you, but they've been great for me, and so I just wanted to share that.
No, I will be because those guys are rare. That is a rare breed of human right there that understands and loves the tax law.
Honestly, my conversation with them happened after my conversation with you,
Yeah.
and I tested them by some of the things I learned from you, and
Oh,
they knew
that's
it at a
cool.
very, very high level, right? And
Okay,
so,
good, good,
yeah,
good, good.
yeah.
Yeah, yeah, yeah. No,
So
that's
it not only solidified you, but it also helped raise them up, right? So it was a really good conversation.
yeah.
So, dude, let's dive into the nitty
Okay.
gritty. Let's go into the
So
strategies and the tactics of how can
let's do
people
it.
that are making a good amount of money, what can they
Mhm.
do to reduce their tax liability?
Yep. So the first one we talked about, which was funneling the commissions into your company and then paying yourself. When you pay yourself, you are going to be your board of directors, and you're going to go on a CEO hunt, effectively looking for you. So treat it as such. Negotiate for your own benefit. When I made my offer letter to myself, frankly, I included a company vehicle, right? So now it's not X amount of miles I get to write off or X amount of expense I get to write off. 100% of my vehicle and insurance, all of my costs are now a write-off because my company owns the car, not me. My company also, in the offer letter, to be able to nab somebody of my caliber, had to offer me a housing allowance. So I've got up to $3,000 a month housing allowance. So now my entire house payment is a write-off. I also get a clothing allowance because there's a certain expectation that from my company that I wear custom suits and I dress nicely.
It's so funny you mentioned that because
Yep.
literally I have wrote down on my notes and I forgot it. Is I was going to introduce you as the best dressed man at every event I go to.
Thank you. I appreciate that. I appreciate that. I tried to dress nicely out of respect for the people that are there and everything. But so I want to make sure you guys like the salary is part of it, but you can add in some good perks in there, just like any other company would. Like when General Motors, which is a Metro Detroit company, when they hire a C-suite executive, these are the kinds of things they put in the offer letters. Like they do give company cars, right? And they drive those cars for 6 months and then they turn back in, they get another vehicle. They're nice vehicles and they're resold to GM employees at a discount. So it's a help for both. And I was looking at this from the strategy of, okay, I got to think like a business person. So let's think like a big business person, a
Yes.
multi-billion dollar business. How would they treat this negotiation? How would they do this? And there's reasons they do it a certain way, tax advantages. So I'll just do it that way too. I'm not going to dig the well. The well's been dug. Someone's already come before me and outlined all this stuff.
Just following the path someone else
That's
has
it.
they've bulldozed the trail, you're just walking it.
Yep. And then next up, after this, the very first thing I would do, the very first thing is open up an HSA, a health savings account. So in 2024, you can contribute as a single person up to $4,150, or as a married person or a person with a child up to $8,300 into this. The reason why I say HSA first before a retirement account is because an HSA is both pre-income tax and pre-FICA, both. And it's about the only thing that is pre-FICA. So what you
What do
do
you
with it, so
can you
like,
break down pre-FICA? What's pre-FICA?
um, um, well, now I'm drawing a blank.
I really don't know. That's why I asked you.
You know what, and I have it at the tip of my tongue as to what the acronyms. I'll come back to it.
Okay.
I will come back to it. Um, so what you do is you take your $4,150, put it into that HSA account. From there, because it's pre-tax, you're saving around $1,200, right? You're not paying $1,200 in income tax. You get to then go and invest that money wherever you wish, right? So for me, this is what this looks like for Mike Perna. I spend about $1,000 a year on medical between my yearly exam, between my contacts, because I've terrible vision, going to the dentist, things like that. My medical bills are about $1,000. So I pay that out of my HSA. So that means I get to invest $3,100 pre-tax, again, saving around $1,200 in taxes into, in what I do is S&P 500 funds. And the reason why I do S&P 500 is because it's a set it and forget it. The adjusted for inflation annual return on an S&P 500 over the last 30 years is 10.74%. It's a great return. I don't need to worry about it, right? And then again, that's pre-tax. When I say pre-tax, when you retire, you can pull that money out of your HSA. You'll have to pay the original tax back. But again, that $1,200 is a zero. Look at it this way. It's a zero interest loan from the government. So they are allowing you to go invest their money for the next umpteen amount of years. And then you make 20, 30, 40,000 on that original $1,200 investment over 20, 30 years. And then you just give them back the 1,200 and you keep that 30,000
Tax free.
tax free.
I love it. I looked up FICA, and
Yeah.
it says U.S. federal payroll tax. Is that
Oh
right?
yeah. Federal payroll tax. That's right.
Yeah.
You're right. And that's number one. And it's an easy one also because it's small. Like if you chunk it out, we're talking like 400, not even $400 a month. So it's not like you're chunking away tens of thousands of dollars into this thing. It's an easy one to set up and you can do it. You can connect it with any brokerage account that you currently have. So let's say you have a
Okay.
Schwab account. Just call Schwab and say, hey, look, I want to open up an HSA for myself and my family. How do I do it? And they'll just walk you right through it. Take you 30
Really good
minutes.
advice. Love
Yep.
it.
Next up, I would look at opening up, if you don't have one, what's called an SEP, a self-employed pension. This is level 2. So in the W-2 world, what we're more familiar with are 401ks, right? That's our retirement savings vehicle. That's our pre-tax vehicle. In the 1099 world, we have SEPs, which are actually better. And I'll tell you why. SEP, the 401k limit, if I remember correct, this year's 401k limit is $19,800. The reason why I don't remember exactly what the dollar amount is because I don't have one and I don't use it. SEPs, I could tell you exactly what it is. It's $68,000. Most companies allow you to put somewhere between 8 and 12% of your gross income into a 401k. With an SEP, you can put up to 25% of your income, capped at $68,000, into your SEP pre-tax. It's the fastest, easiest way to reduce your tax burden. So if I make $100,000, I can put $25,000 into my retirement account, save $8,000 in taxes that I would otherwise spend on that 25 because I'm only being taxed on 75,000.
Yep.
And again, guys, this is a zero interest loan from the government. You are going to pay them back when you pull the money out, but that $8,000 that you would have given the IRS to go build roads or do whatever they do with it, you're going to use to invest and compound interest yourself.
Really good. And I think I want to stop right here. Like
Yeah.
we're talking retirement accounts, HSAs, all of that. I think like I want to simplify for that for someone that may be overwhelmed by those things.
Yep.
There are brokerage accounts. There are people that do that stuff every single day for a living. And I think
Oh,
that
yeah.
if you were to ask anybody that is wealthy, um, they all have some sort of retirement account.
Yes.
All that we are breaking down here is why not start now? And if you can start now to build your retirement account and reduces your tax burden at the same time, it's a win all the way around. And so I think
Yeah.
if we were to ask most of the listeners that and maybe I'm mistaken here, but I know for a fact when I first started diving into this stuff, it overwhelmed me. And so if you're overwhelmed by this, just ask yourself, do you want to build a retirement account? And if the answer is yes, these are the steps to do that while reducing your tax burden.
And that's a great way to put that. That's a great way to put that. And then just doing some simple compound interest math. If I just did it 1 year and put 25,000 in, save the 8,000 in taxes I would pay just on the 8,000 portion. I was just going to pay the IRS anyway. I was going to give the money away anyway. At a 10% return over 25 years, that 8,000 grew to be $96,000.
It's free money.
Yep. And as Albert Einstein said, compound interest is in fact the eighth wonder of the world.
Yes,
It
sir.
really is. Okay. So next up after that, now, okay, and I want to slow down for just one moment and just kind of predicate this. This is how I view the tax code. If you actually print and read the tax code, all 6,900 pages or whatever it is, the first 6 to 8 pages are based on are about what you pay taxes on, what types of income you pay taxes on. The next 2 pages are how you pay the taxes, where you mail the check, logging into irs.gov, right? And the next 6,800 and some odd pages are what you don't pay taxes on. So from World War II to now, World War II really, really codified our tax code in several different ways. One of them was to fund World War II. For the first time ever, the government decided in 1943 to start taking the money pre-tax out of worker paychecks. The second thing they did was they started incentivizing businesses for the first time to do the things they don't want to do. And mainly speaking, that's housing, employing people, and energy creation. So chances are, if you're doing one of those three activities, there's some massive tax benefits and even some tax credits in there. So I want to make sure
Mhm.
that there's an overarching theme as well.
Really good.
So next up, I would use is section 179 of the tax code, which is your heavy vehicle section. Pretty much any vehicle above 6,000 pounds. And there is a list. Every year there's a list that's published that says, okay, these are the 800 vehicles that qualify, right? But if you're driving a truck, just drive a little bigger of a truck. Like I hate to say it, but it's true. So I drive an Escalade. Okay. It's well over 6,000 pounds. When I bought that vehicle, I was able to write that entire vehicle down year one,
Yep.
right? Which you cannot do with a Miata, which I could fit in the back of my truck as well. So the heavy vehicle deduction is big. Now, here's what I would do. You get to choose your year. So you can either take the deduction over 5 years, right? You can split it up. That's fine. Or you can do a one-time 1 year. I would wait until next year to do that, even if you bought the vehicle this year. And here's why. The 179 was modified in 2017 because of the Tax Cuts and Jobs Act. And they said, okay, you can take 100% of the vehicle as a write down this year. But that Tax Cuts and Jobs Act started phasing out 2 years ago. So this year, if you take 100% of the vehicle, you're only going to get a 60% credit. With the result of this election, the president-elect, previous president, has said many times campaigning that his goal is to extend and refulfill the 2017 Jobs Act as part of his first 100 days in office. Whether or not it happens, yet to be seen. I believe it will because we've got a very slanted president, Senate, and House where he can get a lot of things accomplished right now.
Yeah.
And business tax credits and business tax reductions are extremely high on his list. We know this. President Trump, we know this,
Which
right?
is why, going back to what the
Yep.
big aha I had earlier of a healthy economy cycles and circulates money at a faster level. Well, what
Yep.
does that? What fuels that? Business.
Business. 100% business. So if you bought a heavy vehicle this year, I would actually wait until next year or the first 100 days of next year to determine which year to take that write down in because you might get a 40% bonus next year if he does extend the 2017 Tax Cuts and Jobs Act, which I believe is going to happen. I believe we're going to know that answer by March.
And
Just to
this
be,
is a selfish question for myself.
yeah.
So let's say that I buy, my company buys a new vehicle this year, right? I
Mhm.
buy an Escalade, and it
Yep.
costs $100,000, and I
Yep.
want to reduce my tax liability by $100,000 with that vehicle next year.
Yep.
Then I want to buy one again next year. Am I able to do
Yep.
that every year?
You can do it every year as long as you don't. Well, yes, you can do it every year on every new vehicle. Now, when you sell the vehicle, then you
Yeah.
of course got to pay back whatever it is that you recoup. So if you sell it for 60,000, so that 40,000 differential between the 100 that you bought it for and the 60 that you sold it for, you're saving that tax money.
Okay.
You're saving that twelve thousand
But if I
dollars.
keep it,
But if you keep it indefinitely and just run it into the ground, then yeah, for sure.
okay.
Yep. Yep. There's no limit. No limit. Right? It's like telling Caterpillar that they can't go buy 50 machines and have a write down for each one of them.
Yep.
Yep. Next up, and this one is a very small one, but it could be powerful, and it's capped at $3,000, is tax loss harvesting. So if you sell a stock, and here are the rules behind it. If you sell a stock at a loss, okay, and you don't rebuy that stock within a 30-day period, you can take that loss against your ordinary income up to $3,000. It's small, but it's
Sure.
there.
Yeah.
So how I've used this in the past is you're gonna laugh at me. I run a lot of parallel stocks. So like Coke and Pepsi are parallel stocks. Generally speaking, when one goes up, the other goes up. When one goes down, the other goes down.
Yep.
Every once in a while, something happens that disrupts that market. Like muscle milk comes along and just obliterates some of the protein market until one of the two buys them. In this case, it was Pepsi. Um, and then their stock goes down. When their stock ticks down, I take the money, I sell the stock A, and I move it over to stock B. So like Coke went down 6 months ago. So I sold off enough of Coke that I got $3,000 worth of a tax write-off, and I just went and bought Pepsi with it because Pepsi had also gone down the same amount.
Yeah.
Ford and General Motors do the same thing. I'm not kidding.
Dude, that's crazy brilliant, right? Like it's very meticulous and it's in the grand scheme of things, it's small potatoes, but it's brilliant at
yeah.
the same time.
Hey, 3 grand, man. I'll take it. It's a little something, but it is definitely a something. Um, okay. Next up, and I was going to talk about cost segs first, but I think I'm going to actually go in a different direction just because I think
Okay.
this one's a little easier. The Augusta Rule.
Mm.
Okay. So here's what happened. And again, this ties into the 2017 Tax Cuts and Jobs Act. This is when this went into place. A bunch of rich people rent their houses out for 50 to 100 grand for 2 weeks on golf courses like Augusta during, the professional, whatever you call it, pro-ams,
The Masters.
the Masters. Thank you. I clearly am not a bowler. I Sorry, a little big Lebowski joke in there.
Yeah,
Um,
that's like one of my buddies says that's messed up like a football bat because that's how much he knows sports.
Same, 100% same. So,
Except for the Lions I see behind you while we're on sports, man. How
oh,
about the
bro,
Lions?
I was gonna
The
end with it, but we're going there. If you're saying
Lions.
it,
Yeah. I
that's
mean,
it,
I'm a
guys. That's
Chiefs
my
all the way,
prediction.
but I respect the Lions like that. I love their coach. They're killing it,
Dude,
man.
Dan Campbell is a killer.
Yes.
Like that
I
dude
want to
is
go play for
a
that guy.
serious dude. Yeah, he's awesome. He's amazing, and yeah, I gotta represent the Lions
I
this
love it,
year,
man.
all years. That if any, that's it. That's my prediction for the NFL is that the Lions will actually make it to and win the Super Bowl.
I
I
agree with you on the first part. I think they'll make it. I don't think they'll win it.
really
Yeah.
who? Give me one team that could take the Lions right now.
Chiefs.
Really?
Yep. Anyway,
Oh.
back to taxes. We'll argue
Anyway,
about
okay,
that
okay,
later.
okay. Okay.
I
So
hope I hope that it comes down to that, man.
I think that'd be amazing. And if it does, by the way, I am going to the game.
All
And if
right.
it's
Let me know.
the
I'll meet
Lions are
you
there,
there.
I'm going. Yeah, if the Lions are there, I'm going no matter what. I mean, come on, dude, the Lions were so bad for so long, so bad. Um, okay, Augusta rule. All right, so the rich people on the golf courses said, "Hey, look, for the 10 days or 2 weeks that we're renting out these houses, I don't want to pay taxes." And then the government was like, "Well, you're rich and you donate a bunch to our campaign, so okay, we'll go with it." That's a lot of how tax law works, by the way.
Sure.
Um, so you get to rent out your primary residence for up to, but not to exceed 14 days per year and not pay taxes on that income. If you hit day 15, you pay taxes on all of the days. If it's 14 or less, you pay taxes on none of the days. So here's how this works. They included the words intended use in the code. So my house right now, I could rent out for, let's call it 3,000 a month, right? And let's say if I rent it out for 14 days, that means I would make around $1,500. Using this rule, I would save like $400 in taxes. It's barely worth even thinking about, right? I mean, I'm not saying $400 is nothing, but it's like, why go through all the rigmarole for
Yep.
400 bucks? But then there's the words intended use. So my intended use is I do a leadership retreat 14 times a year at the house. If I was going to do a leadership retreat somewhere else, I wouldn't do it at a house. I wouldn't go rent a house down the block. I'd probably go to the Hyatt and use one of their meeting rooms. So the Hyatt, which is the closest hotel to me, to where I live, to my house, I called them and I said, "Hey, look, can you shoot me a quote for an 8 hour retreat with audio visual, soda, coffee, water, and some snacks?" And they sent me the bill and it said $4,500. That's a lot different than 120 bucks or whatever the other number
Yep.
is, right? So $4,500, I produce 14 bills, I bill my company, Michael Perna, the individual, bill my company, the Perna team, in the amount of $63,000 total. I actually pay myself. You have to move the money. The money must move and flow. It always does. Because if you ever get audited, the IRS will actually say, "Okay, hey man, did you actually move the 63,000 or do you just leave it in the company account? Because if you left it there, then give us the tax money."
Yep.
They will do that, right?
Sure.
I mean, let's say my tax rate today is 30%. So that means that I saved 18,900 because my company gets to write it off and save 18,900 and I don't pay taxes on that money.
Yep.
Guys, it's 19 grand. That's a lot of money. And
Yep.
you don't have to go to the extreme that I did. You can do it in the amount of 1,000 per day. You can do it in the amount of 2,000 per day, whatever makes sense. And you got to be able to prove if you're audited, and I know this because I was audited, you got to be able to prove if you're audited that if you were to go somewhere else, it would have cost what you have
Which
been.
why that invoice is brilliant, right?
Yep. And that's why I have that invoice and I get a new invoice every single year. I call the Hyatt, and I have them send me the same thing every year.
Yep.
Right.
Brilliant.
The number keeps going up, so I just keep moving my number up. Right. Easy one. Easy one to do. The Augusta rule. Even if you do it at a small level at $500 a day, guys, that's still like 9 grand. No, 7 grand. Sorry.
Yep.
Yeah, written down on your income. Okay, cost segregation. So we're all in, well, I want to say we're all in real estate, but many of us are in real estate. A lot of us watching this podcast are in real estate. We have a unique advantage of getting listings first, seeing them before they come to market. Every time we list a home, every time I walk into a seller's home, the first question I ask myself is, should I be buying this property? And we should be. Because
Yep.
the reality is, all of my investment properties this year, the half a dozen homes so far that I've closed on, were all our listings, literally, except one of them, right? So here's how this works. Up until 2017, you were allowed to depreciate property, but only over a 27 and a half year period. Now, with cost segregations, you can accelerate a lot of the depreciation down to a 5 year period. Okay. We'll use a real world example. I bought a house in Royal Oak, Michigan for $250,000. Okay. You can't depreciate dirt because it doesn't depreciate, it just stays, which is generally speaking 20% of a home's value or 20% of a total property's value when you've got a house on it, not vacant land, but when you've got fixtures,
Yep.
right? So that means I can depreciate $200,000. I chose to do accelerated depreciation. I had a cost segregation engineer out to the property, cost me 1,500 bucks. And he noted in his report, very similar to an appraisal, okay, your refrigerator has 3 years of life left on it. Your roof has 4 years of life. Your carpet has 2 years of life. Your paint has 1 year of life. All these different things showing I can depreciate all of those things that much faster. He gave me 31% on that property year one. So that year, I was able to actually write down of the 200,000, $62,000 off my income, which ended up saving me about $18,600. Previously, I would have been able to write down $7,227 because I had to extend it out over 27 years, which means I'm only saving like 2,100 bucks on my taxes.
Yep.
But this changes the game for investment properties for me and how I qualify them because like before this, I would not buy a property unless I was cash flowing a minimum of $500 a month, positive cash flow.
Yep.
Now I can cash flow 150 a month, which is enough to cover any expenses and maintenance because I'm getting back 18,600 on the other side, which is actually $1,500 a month. Right? So like this property in Royal Oak, when I bought it 3 years ago, and I'm 3 years into the cost seg, I was renting that property for well, no, at the time it was 1850 a month. The next renter came in and I rented at 2,000 a month. Now I've got the third renter in it. I've got it up at $2,100 a month. Over a 5 year period, I'm going to have that at $2,400 a month. So
Yep.
the deal didn't make sense at 1850 a month because my mortgage on it was 1650, 1675, right? At $175 a month, the juice isn't worth the squeeze because something can go wrong, in my opinion, as an investor.
Yep. Agreed.
But I can delay the satisfaction of having the higher rents because I know rents are going up 8% per year because I've got the cost seg and because I'm saving what will end up being around $45,000 in IRS taxes over a 5 year period. It's okay. I can make less money today on these properties, which means I can widen which properties I actually buy.
Still good.
Does that make sense? Did I explain that?
100% it does. I want to stay there though because this is a real
Yeah.
estate driven podcast, and I think this is the big one I wanted to go deep on with you.
Yeah.
Um, I think all of us, at least most of us, own a home, right? And most of us either help investors or are an investor trying to grow our real estate portfolio.
Hmm.
And if you're not, you should be.
Hmm.
But you should be doing that because it helps you get off the real estate hamster wheel. There's all kinds of benefits to it,
All kinds of
right?
benefits.
But
Yeah.
one of the benefits is if you go back and look at your marketplace over the last 5 years, the last 10 years, 15, go 5 year increments and go and look
Mhm.
what your average price point was in your market. It's way higher now than it was then. And so if you're
Yep.
buying it at the 250,000, it's probably worth 300, 325 now,
Yeah, it's
right?
about 325 right now. I've gained
Yep.
70, 75,000 in
That's just
equity.
rough math of overall
Yep.
marketplace. And so
Yep.
not only are you could look at it through the lens of I'm only cash flowing $100, the juice isn't worth the squeeze, or I'm saving, what was your number you're saving per year in taxes?
18,600 year one.
Which is 1,500 a month.
Yeah.
So you are
Real money.
cash flowing 1,500 a month, and you've increased the property value
75,000.
$75,000.
And I've
So
also paid it down $3,600 a year for the last 3 years.
you haven't, your tenant
No,
has.
no, the tenant has. Good point.
Right. And so but if I talked earlier about getting an investment account. This is the juicy stuff I really wanted to go deep on. And this is
Yep.
something I'm personally just knee deep in right now, trying to figure it out myself. And I'm trying to buy all kinds of stuff. Right.
Yeah. Yeah.
And I think number one, it's just because I think the real estate market's going to just accelerate very, very rapidly again. I truly do. I think we have pent up demand. And so I want to take advantage of that. But also, I just want to invest and grow and I want to reduce my tax liability. And this is one of the easiest ways to do it, especially if you're in the real estate space. You can you can not only buy something that is cash flowing, but you can depreciate it, reduce your tax liability significantly. Someone else pays down the principal and it
Hmm.
gets worth more money. Like,
Yep.
I don't know how many times that is, but that's like 4 or 5 times you're making money off of one decision.
And that's it. And I was actually just pulling up. I've got a estimated value of home ownership calculator, right? Which is interesting. I just put in $250,000 just to put this property in. My year one estimated value is $15,097 between 10,000 in appreciation, principal reduction of 20,000 $2,032 and tax savings of 3,066. And that's not including my own cost segregation and that's not including what the tenant's paying me on top of what I'm paying out to the mortgage.
Yep.
Crazy, guys. It's crazy. And then here's another way to look at this, right? Okay. My opinion for all the young gentlemen out there that are looking to settle down and really get into family mode, every time you have a child, go buy a duplex or a triplex,
Mm.
right? Because 18 years down the road, that property will have over doubled in value, almost tripled. You will have paid off 35 to 40% of the mortgage, and the cash flow will have increased substantially. So now you've got a vehicle to pay for that child's college education.
Way
That was
better
paid
than
for by
investing
somebody
in
else.
a college account.
Mhm. Yeah. I mean, I would personally, if it were me, I would do both. That's just my own personal opinion. I still open a 529 for my kid. The Michigan program, for example, is actually very strong on the returns. However, it really, I mean, I'm trying to bank against. I have zero idea what the cost of college is going to be 18 years from now. If you are having a child right now, 18, think about how much it is today. 18 years from now, it will probably be triple.
Yep.
Like University of Michigan, it costs just a little over $30,000 to go there per year. 24 years ago, when I was thinking about going to U of M, that was $8,500 a year,
Yeah.
almost 4 times the amount, guys.
Yep.
Like,
Crazy.
and and I'm not saying that college is for everybody. So then that provides another layer of safety. Let's say that your son or daughter wants to go to trade school and they don't spend several $100,000. Well, guess what? They still have that duplex or that triplex that they can sell and pay for a wedding because those are expensive.
And I
Or
want to add
start their
another, I want
investment
to add
account.
another layer that just popped in my head that has me like all the stuff that I just shared of like those 4 ways to make money. There's another one that I'm even more excited about. And
Okay.
that is called a cash out refi.
Yes.
Because that
Oh my
money,
God.
if you decide if it's an asset that you want to keep five
Yep.
years from now, 3 years from now, all of the things that we just said are true. But now that equity that you have from both compounding equity, the tenant paying it down, and the increase in value, you can pull out 80% of that 100% tax free. That is free
Yep.
money,
Yep.
and you don't have to pay a dime for it.
Nope. You sell the property, now you're paying the
Yes.
IRS. And you're losing a cash flowing product.
Yes.
So cash out refi.
Yep. And
Yeah.
I will just share from this is my personal opinion. I grew up, and I think we're all a product of kind of our how we were raised, right? And I just grew up with very, very humble beginnings, and I've had my back against the wall a time or 10 of how am I going to pay my electric bill, those sorts of things, right? And
I've been
just
there.
very, very fortunate to be able to live the life I'm living now. I'm very, very blessed, but I still have a little bit of that. This is actually the guy that I was talking about from the tax company. He gave me this phrase. He shared that it's at lunch. And I said, "Oh, dude, I'm stealing that." He's like, "That's just the trailer park still in me." Right. That's just the trailer park in me. And like, I feel
Yeah.
that. Right. And
Yeah.
so that's my trailer park version of me is just like, I want to be super safe. And I don't want like I own like 14 doors and I have like the opposite of where I should be in equity in those. Like I owe less than 20% on all of those. Right.
That's amazing.
And,
That's
and so
amazing.
like, that's awesome. And it's great. But if I had to do it over again, you know how much money I left on the table?
Oh my gosh, the Burr method. Yeah, yeah, yeah.
Right. Like, and so, and I'm not saying everyone be super aggressive and go crazy with it and that's your own, but like, so be strategic and be smart, but realize that let's say that I have a duplex that I paid 200,000 for and it's worth 325 today.
Hmm.
Like, I can literally today interest rates got to adjust, right? But today,
Yep.
say I owe 50,000 on that, I could go cash out $200,000 that is now my money to go buy another deal to do the same thing over again. And there's no, like I pay nothing for that money.
Yeah.
Or maybe I just want to go on a fancy vacation or buy a boat or whatever, right? That's free
Yep.
money, right?
Free
Because
money.
you're being smart, you're saving money, you're buying an appreciating asset, but also you're able to get more money for free.
Yep. And you're absolutely correct on that. Absolutely correct. Um,
Dude, I'm gonna get off here and go buy something.
I know, right? I know. I'm thinking the same thing. And then from there, when you own like, and there are several ways to buy these properties, right? You can obviously just pay cash for a property. You can do a 20 or 25% down loan, which is going to be predicated on your income. You can do a DSCR loan, which is an investment style loan, which is not predicated on your income. So if you already have a mortgage and you're exceeding 28 or 36% or whatever that looks like, the mortgage company is going to be hard pressed to give you another loan based on your income. So the DSCR loans are investment loans that are based on what the property will be rented for. And they've got those numbers. So they give you 75% credit. So if you can rent a
What type
property
of loan is
for
that?
DSCR.
DSCR.
Don't know what it stands for, but I know that that's the
Yep,
acronym.
all good.
So what they do is you still got to put 20% down, but they say, hey, look, if you can rent this property out for 2,000 a month, we'll give you a credit today in the amount of 1,500 against the payment,
Got it.
right? So the payment is again 2,000 a month. Let's just say, just keeping all the numbers round. Now all I need to qualify for is a $500 a month loan, not a $2,000 a month loan. So for a lot of people, when they talk to just a normal loan officer that doesn't know a lot about investing, they'll say, nope, you can't qualify for another $2,000 in payments or 2,500. But you don't have to if it's an investment property,
Yes. That
much
dude,
less.
that's really, really good. And that's really good advice. It reminds me of something that like, and I don't know where everyone is listening to this, but let's say like one of the things that I'm really into right now is yes, I own duplexes and I think duplexes and fourplexes are great, but where I think they really get magical is at 5 or more units.
Agreed. Oh my God,
And
it gets
the
so much easier at
right.
five more
And yeah,
units.
and
Yeah,
and I
yeah,
think the reason I'm this is very parallel. And the reason I think it is because it's way easier to get money on those
yep,
because they're not seen as a home, they're seen as a business.
yep.
Right.
Agreed.
And what
Agreed.
you just what I heard you say with the DSCR loan is it's a very similar mindset, but you can do it on smaller properties.
Yep.
That's
Yep.
that's
And I
awesome.
know that that specific loan is not offered in every state, but I do know that there are loans in every state that are comparable.
Awesome.
Right?
Good stuff.
And then the last way to do it, or second to last way to do it, you can do it as a land contract, of course, if you want to just keep a loan off your credit entirely, right? Um, and then the last one is doing a subject to,
Yep.
which I've been doing a lot of in the last 2 years. So subject twos, and there's a lot more detail we can get into that we won't get into today. But the basic premise of it is if someone else has a favorable, in my opinion, the way I do it is I look for favorable interest rates on properties that have been on the market for over 100 days. And I just call them up. Hey, why can't you? And this is where I get this is why I do this on my own listings. Hey, what's going on that you can't sell the house? I call my agent. Hey, what's going on that the house isn't selling? Well, if they lower the price anymore, they're gonna have to come out of pocket 10 or 15,000 at closing between the realtor fees, closing costs, transfer tax, title work, all the things. Like, great. What do they need? And most
Yeah.
of the time they're like, man, in this case, they'd be happy if they just walk away with 5 grand. Like, great. Let's get in a room with the seller. And I'll be like, hey, look, Mr. Seller, how about we do this? How about I'll write you a check for 5 grand at the closing, right? You'll get it from the title company, of course. I'll pay your real estate agent's commission because then I'm just paying my portion or to my own agent that's on my
Yep.
team. I'll pay the 4,000 in closing costs, transfer tax, and title work. So at least you're getting something out of the home. But here's the deal: you got to leave the loan on the property indefinitely. And this guy's got a 3% interest rate, 4% interest rate, 4.5% interest rate, not today's 6.5 or 7. And that's what makes these deals work is I
Yep.
need those lower interest rates until rents can catch up when I want to refi out 3 years from now.
100%.
Right. And it's much less out of pocket. So the last one I did was 192,000. I was out of pocket $9,500 total. Right. So $9,500. So let's look at this from this perspective. $9,500 divided by 192. So I was out of pocket 4.9% of the purchase of the home price, which is nothing. Which is, I mean, it's not nothing, but like it's
Yeah.
negligible versus like
Dude, the
20.
cash on cash return on that is
Mhm.
got to be through the
Insane.
roof.
And that's what I'm looking for, right? I'm looking
Yep.
for if I can get back, here's my rule of thumb. If I can get back 100% of my cash in 5 years or less, I will do the deal.
Mm.
Whatever my cash investment is. Doesn't matter what it is. I just want the money back so I can cycle it back out to another property fast. So I got 9,500. That house 192,000. I'm going to do a cost segregation on it. So 80% of that is 153,600. My engineer gave me 34% on that one, which means I get to write down my income $52,000, which means I'm saving at 30%, $15,600 minus out the original $9,500 investment. The IRS just paid me $6,100 to buy this home.
And you have the asset.
And I have the asset. And I have positive cash flow. And I have the mortgage that's being paid down, which is now mine. Why
Yep.
would I not do this as many times as I can?
Yeah.
Right? Now, here's the key with this. If you do this with specifically FHA loans, they could enact, and they have in the past, I've seen it happen, the due on sale clauses. So you got to get these properties back into an LLC, and then you got to wrap that LLC in a trust in Wyoming so that they can't initiate the due on sale clause. And there are companies that actually do this.
Yep. That one, the company I mentioned earlier,
Yep.
that's one of the things they do.
That's one of the things they do. And they probably allow you to do it in like packs of 5 or 10. So
Yep.
like one of the companies that I've used to do it, they're like, hey man, the price goes down for how many you buy. So I just went and bought 10 of them. So I just said, hey, let me buy a 10 pack from you. I know I don't have enough properties today. I only had
That
four
will.
properties I needed to go in, but I've got 6 of them waiting there so I can go buy 6 more homes with FHA loans on them. And I'm not worried about due on sale. I don't care. It doesn't
Yep.
bother me.
Dude, that's brilliant.
Did I go
Man,
through that
so
way too
good.
fast?
Huh?
Did I go through that way too fast?
No, not at all.
Okay,
Maybe
cool.
not for me. But I don't. I think that is a sophisticated conversation that is going to
That
require
one's
more time
sophisticated.
for people to understand, right?
Yes.
Um,
Yes.
but yeah, dude, I got a lot of value from it. So I'm sure a lot of others did too.
We got time for one more?
Yeah.
Okay. Pay your kids. Get them on
Yes.
actual payroll.
I just
Actual.
started doing that this year.
Did you? Good. 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 And when I say actual payroll, I don't mean like give them a weekly allowance. That's garbage. That's your taxes. That's it. That you're paying the tax rate that you are at, not that they are at. When I say put them on payroll, I mean call. I mean if you don't have anyone on payroll, which can be a very scary thing. Like a lot of people, like think about this. Most real estate agents and most business people, before they got into business, they were a W-2 employee. So they received payroll through somebody, but they didn't actually set it up or understand it or do anything with it. If this is your first time putting somebody on payroll and it's your kids or anybody for that matter, it's actually really, really easy. All you got to do is call ADP. Literally, just pick up the phone and call.
Yep.
Call Augusta, call Payroll Inc., call any of these companies, and they want your business. So they will just handle all the details. Literally, they'll pay the taxes.
Exactly what I did.
Yeah, I mean, it doesn't take a lot. I mean, as a guy that's got 20 people as employees right now, I'm gonna tell you, it was super scary the first time I hired somebody because I had no idea what I was doing, and so I literally just called ADP and I was like, "Hey, look, I just made a hire. I don't know what to do." And they're like, "Did you ask for their social security number so you can put it in the system?" I'm like, "No, I didn't even know that.
Yep.
Thank you." Like it was really bad, guys. It was really bad.
Yep.
So you can put kids on payroll. They don't have to be your kids, by the way. They don't. They could be your niece, they could be your nephew, they can be anybody. right? Anybody's kids, as long as they're under 18, you can put them on payroll. So this is what this looks like. The first, I believe this year is $11,600. That sounds right. The first $11,600 of income is taxed at a low rate of 10%, which is probably a lot less than your rate, which is really high. See, the goal here, guys, is to keep reducing your income to bring you back into lower and lower tax brackets.
Reduce your income, reduce your taxable income.
Reduce your taxable income. Yep.
Yeah.
So then you put them on payroll. And the way I do it is I've got a niece and a nephew that's cute as a button, and I put them in Perna team shirts, and their job is to be, frankly, models for the business. So I put them in Perna team shirts, and we take really cute Christmas card pictures, and I use them on Facebook and all the things, right? They're paid child actors. True story. So then I pay them. It goes into a custodial account jointly held by myself and them. Their name's got to be on the account. That's number one. They have their own debit card. Okay. But now when we go out to dinner, it's my niece and my nephew using their debit card treating me to dinner at their tax rate, not my tax rate. That makes sense? If we're going to go bowling, they're going to pay for bowling. And it's such a nice thing that they do for us, pay for bowling for me. It's so nice. Very generous, very generous. Now, what I do is, or what I would also recommend doing is just the investor in me and the long-term, money is a function of time kind of investor that I am. I would take the largest portion of that and max out their Roth IRA.
Yep.
So two things happen, right? Like if they're in hockey and hockey's super expensive to get ring time and like all that stuff, sure, have them pay for it at the lower tax rate using their debit card. But also put that 7,000 a year, 7,000 this year into the Roth IRA. If you do that starting at age 1, add again the average S&P 500 return rate of 10% per year, and you just do the 7,000. You don't even increase it every year with the increases that they do, just the 7,000. When they turn 18, they will have $358,000 in their retirement account. And if they continue not to touch it and don't fund it with another dollar from 18 to 65, that money will be worth $1.99 million. You are literally setting your kid up with a $2 million minimum retirement account.
It's brilliant.
At the low cost of you get to save taxes anyway.
Yep.
Guys, this was all designed. Like, we got to remember, Congress is a bunch of rich people, and rich people put in rich people rules. So all we got to do is think like a rich person and start following rich people rules. That's all the tax code is. Seriously. Literally.
And it's, man, you exceeded my expectations. This was an absolute masterclass. I'm sure we'll have people reaching out, asking questions.
Yeah, always, anytime. I'm always around.
What would be the best way for someone to get a hold of you if they have questions on this specifically? Of course, I'm here to help, but as you can tell, he's the expert.
Shoot me a call, shoot me an email, or shoot me a text, any one of the three.
Okay.
My direct number is 248-425-5082. And it's Michael Perna, Michael, Michael, Perna, P as in Paul, ERNA, at pernateam.com.
Awesome.
Any way you want to do it. I'm always here, guys.
They're going to blow you up, man. I love it because this was so good. So good.
Dude, this was a lot of fun. Thank you. I appreciate it.
Dude, thank you so much for this. And yeah, Chiefs are going to kick the Lions' ass. Sorry.
Hey man, we all have dreams. We all have dreams and hope.
Hey, but
they'll come true.
No hate. Lions, dude. I'm secretly rooting for them, but I'm a Chiefs fan first. So,
hey man, the Lions are America's team this year. That's all I'm saying. Hey, the Chiefs are good. I will give you that.
Yep.
They're not that good.
Time will tell. We will see.
Hey man, it looks like I'm gonna see you at a Super Bowl. That's what's gonna happen.
I hope so, man. I hope so.
That'd be a lot of fun.
Maybe your niece and nephew can buy me a drink or something over there.
Hell yeah. They're good for it. I mean, they're like 4, but they're good for it.
Just kidding, man. Cool. Dude, thank you so much for sharing this wealth of knowledge. I know for a fact this helped someone here. It helped me.
God, I hope so.
And I know there's people here that are at the beginning of the journey, they're in the middle of the road, or they're at the, like, I have too much tax liability and all these I think I got 8 steps that I wrote down and took notes from you. Man, there's so much gold there. So thank you so much for your time. I truly appreciate it.
Absolutely. No, thank you for having me, Matt. And seriously, anybody, if you're struggling with this or you're talking to your accountant and they're struggling with this, I have literally talked to a dozen accountants myself at this point and been like, hey, pull up this section of the tax code. Here, read this with me. And have helped instruct accountants themselves. You don't necessarily need to change accountants. You just need to make sure the accountants know enough about the rules that they can file your taxes properly. So especially if it's like a family friend, I'm not saying go change.
Sure.
Just make sure that you're educated and they're educated enough to make sure you're getting your fair due. The government put it in there for a reason. It's
Yep.
your money.
It's their policy. We are just using it to our advantage.
Absolutely.
And as a reminder too, guys, I have a connection to someone
Mhm.
that's working really, really well for me. If you would like a connection, reach out and I will connect you to them, and introduce you to see if maybe they'd be a good fit for you too. And again, Perna, dude, thank you so much. It's been a pleasure as
Always.
always. And I
Always.
love
Thank
the
you.
dress, man. You're always looking snazzy.
Did not want to disappoint. So,
I love
yeah.
it. Well, guys, thank you so much for listening. As always, I hope this was valuable. Just a reminder, I do this to give back to you guys, and I know for a fact this is timely for a lot of you listening right now. I want to
Mhm.
ask you a huge favor. Share this with a friend that it can help. So many of us struggle with taxes, and Perna started with this. I just hear this way too often of people getting they think they're making an X amount of money, they forget to pay their taxes, and then they're embarrassed. Don't be embarrassed. It happens more often than you think. So there's somebody out there that maybe you don't know is struggling with this, that this episode could help them. So share this with a friend, help grow this movement. Parna, thank you so much. We'll see you next time.
Thanks, Matt. I appreciate it.